Hi, welcome to another video in the AS A-level managerial accounting series. In this video, we're going to study about the costing for materials and how to value inventory. More about inventory valuation. So, speaking about inventory valuation principle that you've already studied in the IGCSE accounting also, inventory should be valued at lower of cost or net realizable value, also called NRV. So you calculate the cost of the inventory, then you arrive at the NRV of the inventory, and whichever is lower, you will value inventory at that value or at that amount. Next question is, what do you mean by cost and what do you mean by net realizable value when it comes to, valuation of inventory? There has to be a concrete definition of these terms. So what is the cost of an inventory? Cost of an inventory is the purchase price of that item of inventory, the price that is paid to buy that inventory from the supplier, plus all other costs that are incurred on that inventory item before that inventory item is brought to the business location or before it is brought at its current location and current condition. So additional cost examples would include expenses like carriage inward, custom duties, especially if you're importing the items from some other country, or any other cost that is necessary to be incurred, because if you don't incur that cost, you will not get the inventory at your business location. So all such cost and along with the purchase price of that item forms the cost of that item. Then coming to the definition of NRV or the net realizable value, it is the estimated selling price of that product less any costs that are necessary to complete that product and sell that product or sell that item. What do you mean by completing and selling the item? So sometimes inventory items may not be in complete form, or you may have to do some kind of processing, packaging, or any other cost may have to be incurred on that item before it can be sold. So all such costs are called costs of completion. And even before it can be sold to the customer, some selling cost may have to be incurred like carriage outward or sales commission. So after you deduct the cost of completion and cost of selling from the estimated selling price, you will arrive at the net realizable value. So once you arrive at the cost and the NRV, you take the lower value and you use that value to value your closing inventory. Use that amount to value your closing inventory. If you want to know the detailed logic of this particular principle and the accounting principles that form a basis of this inventory valuation principle, you can watch my video on IGCSE inventory valuation chapter. It is there in the IGCSE playlist, and I'll also put a link in the description box below so that you understand why is inventory valued in this way. I'm not going to explain that in this video. In this video, what we are going to further understand is how to arrive exactly at the cost of inventory. Yes, cost is the addition of purchase price and other additional cost, but there are some complications involved when valuing or when finding out the cost of that closing inventory, which we will study in this video. So there are cost flow assumptions that have to be made when finding out the cost of the closing inventory. What do you mean by cost flow assumptions? It relates to the movement of the inventory. See, inventories are received in batches and they are also issued or sold in batches. So how can one establish a relationship between what particular inventory is being sold at what time? For example, you may receive a batch of inventory, let's say batch A. You may receive, let's say 100 units. And then when you are selling products, you will obviously sell from this particular batch because as of now you just have this batch. Let's say out of this batch you have currently sold only 70 units sold. So you still have remaining balance of 30 units. But before those 30 units are sold, you receive another batch, batch B, and you receive additional 100 units. So now you're left with 100 units of batch B and 30 units from batch A. Let's say this time you are selling 50 units. Now, how do you sell those 50 units? Do you sell 30 units from batch A and balance 20 from batch B? Or do you sell the entire 50 units from batch B? Or you don't try to establish a link, so and so batches, so and so units from batch A and so units from batch B. You just issue inventory based on an average. So these cost flow assumptions have to be made when valuing inventory. You have to assume that you are following a certain way of inventory movement. So we'll discuss three of these cost flow assumptions. The first one is called first in, first out. In short, you can call it FIFO. In FIFO, what happens is the assumption is items that are received first will be sold or issued first or dispatched first. So in this example that we spoke about, later when we had to issue 50 units or we had to sell 50 units and we had 30 units from batch A and remaining 100 units from batch B, this should come from batch A 30 units and the difference or the remaining from batch B 20 units. Why? Because that's the assumption we are making, that items that were received first will be sold or issued first. So in FIFO, what we can also conclude is that the closing inventory that remains at the end will always be from the latest batch of items received, which is obvious because if you're issuing items from the earliest batch, the closing inventory will always remain from the latest batch of items received, and this will be helpful in valuing the closing inventory because batch A and batch B may not always be received at the same cost price. But since now we know that closing inventory will be remaining from the latest batch, we will apply the cost of batch B onto the closing inventory and not of batch A. That is FIFO. The next one is called last in, first out, which is exactly opposite of FIFO. It's also called LIFO. Here, the assumption is that the dispatch from the inventory items or the sale of inventory items is always from the latest batch first, and then if required, the earlier batches are used or dispatched. So it also follows that the closing inventory in this case will always remain from the earliest batch of items received. It is exactly opposite of FIFO. For example, in A and B, in our example, after batch B was received and we had to issue 50 units of items, what we did in FIFO, we did 30 from A and 20 from B. But in this case, if we are following LIFO, we would issue the entire 50 units from batch B because that is the assumption in LIFO. And finally, we have the weighted average cost method. Sometimes for some businesses, it is not really possible to classify or differentiate between batches and clearly state that items are being issued from which batch, because maybe the items are just mixed together and the issues are just random. So the businesses wouldn't want to really follow FIFO or LIFO. In that case, they can follow weighted average cost method. So the cost of all the batches, the weighted average cost of all the batches is taken, and then it is assumed that the issues or sales are from all the batches on, let's say, on a weighted average method, and even the closing inventory that remains at the end, that will be valued at the weighted average cost. We will understand these situations with the help of examples. But from your examination point of view, remember that questions will only be tested on FIFO and AVCO method and not on LIFO method. No questions will be asked. No numerical questions will be asked on LIFO method. Maybe they could ask some theory questions or just statements on LIFO may be given in the multiple choice questions. So even in this video, we are going to focus on FIFO and average cost method examples. So the following receipts and issues of a component of raw material happened in a factory. Details are given here. On July 2, you can see 8 units were received. Then July 9 and another 9 units received. July 24, then 7 units received. And if you realize, the cost of these batches or the units received are always different. And issues from issues of these materials were done on July 7, 16 and 27. What we are supposed to calculate is the cost of raw materials issued, basically the materials issued on July 7, 16 and 27, what is the cost of those materials that were issued? And second, we also need to calculate the value of the closing inventory. And in this example, we are first going to follow FIFO. We are going to use FIFO to calculate these values. Quickly, again revising what is FIFO. See, on July 8, when 8 units were received, we had 8 units in closing stock after July 2nd. Then on July 7, 6 units were issued, and obviously these 6 units would be issued from July 2 batch, which is obvious because at that point we just had one batch of items that was received on July 2. And after this, 2 units were remaining in closing inventory, and these 2 units also belonged to July 2 batch. Then on July 9, we received additional 9 units. So 2 plus 9, and now we had in total 11 units. Then on July 16, 10 units were issued. Since we are following FIFO, our assumption will be that these 10 units, 2 units would be issued from July 2 batch and 8 units would be issued from July 9 batch. So that makes it total 10 units. And so let me deduct minus 10 here. So we still have 1 unit remaining in closing inventory after July 16, and this is from July 9 batch. Because in FIFO, obviously the closing inventory will always be from the latest batch. And then on July 24, we receive another 7 units. That's the third batch. Then July 27, 6 units were issued. So these 6 units, 1 unit would be issued from the July 9 batch, and remaining 5 units would be issued from the July 24 batch. So earlier 1 unit plus 7 units received, then we issued 6 units. So at the end, after all the transactions, we still have 2 units remaining in stock, and obviously these 2 units would be from July 24 batch following the FIFO method. So that's the overall flow of inventory. Now coming to this cost of raw materials issued. So whatever raw material or whatever units were issued on each of these dates, July 7, 16 and 27, we'll just calculate the cost of these issues. So first we'll calculate the cost of raw materials issued. Let's do it date wise. On July 7, 6 units were issued. So 6 units, and the cost of these units would be $250. So that makes it $1,500. Then on July 16, 10 units were issued. We discussed 2 units would be from July 2nd batch and another 8 units from July 9 batch. So 8 into $275, because cost of each unit in July 9 batch is $275. And when we take the total, we get 2,700 for July 16. And the same thing we'll do for July 27. 6 units issued. 1 unit was from July 9 batch. So 1 into $275 plus another 5 units from July 24 batch. So 5 into 300. So that makes it $1,775. If we take the total of 1,500, 2,700 and 1,775, we get the cost of raw material issued, which is $5,975. Now let's calculate the value of closing inventory. At the end, we had 2 units of inventory left. So these 2 units would be obviously from the latest batch, which is July 24 batch, and the cost of each unit is $300. So the value of closing stock will be 2 units multiplied by $300 per unit. So that gives us $600. So that's how you follow FIFO, and you can calculate the cost of raw materials and the value of closing inventory. The same example now we will be solving using the average cost method. So in AVCO method or in average cost method, we clearly cannot always state that the materials that have been issued are from a specific batch of items. So what we do is we try to calculate the average cost of all the items received during the period and then just apply that rate onto the materials issued and the closing inventory. So this way we are just averaging out the cost. So first let's calculate the average cost of materials received. How do we do that? On July 2nd, we received 8 units and cost of each unit was $250. So the overall cost for this particular batch is $2,000, 8 into 250. Then we received 9 units and the cost of each unit was $275. So 9 into 275. And then we received 7 units and cost of each unit was $300. When we take a total of all these values, we get the total cost of all the batches or all the items received. But we don't want total cost, we want the average cost, weighted average cost. So to find the average cost, we'll have to divide the entire value by the total number of units received. So 8 plus 9 plus 7, so that's 24 units. And that's how we get the weighted average cost of each unit. So when we do the calculation, we get $6,575 divided by 24 units and each unit 273.96. You get some decimals, so you have to round it off to 2 decimal places. And this rate then we will apply to the raw materials issued and the value of closing inventory. So the cost of raw materials issued would be 22 units multiplied by $273.96 per unit. Why 22 units? See, take the total of total issues, 6 plus 10 plus 6, 22. So the total cost of issues, 6,027.12. And the value of closing inventory, again 2 units remain in stock and value of each item is 273.96. So that gives us the value of closing inventory as 547.92. So this is how you do the average cost method. Now that you've understood cost flow assumptions, let's understand the different types of inventory systems. So a business can use 2 types of inventory systems to keep a record of and track their inventory transactions. One is the periodic inventory system, which is a simple inventory system compared to the other one, and where transactions are not maintained or recorded on a daily basis, or every time a material is received, maybe transactions are not recorded in the inventory books. Periodically or occasionally, maybe at the end of a month, end of the quarter, at some period, the inventory transactions are taken count of. Basically, you see what materials were received, what materials were issued, what is the closing inventory. You try to value the closing inventory either using FIFO or average cost method, and then arrive at the cost of materials issued and cost of closing inventory on certain dates, not on a daily basis, basically periodically. That's why the name periodic inventory system. The inventory calculations that we just did in the previous 2 slides using the FIFO and AVCO, you can say that those were examples of periodic inventory system. Another way of having inventory records is the perpetual inventory system, where detailed and continuous inventory records are maintained. Whenever inventories are received, entries made in the inventory records, these are detailed records. Whenever inventories are issued, again the entries are made in the inventory records. Continuous closing balances are available through such records. On any given day, if you want to know the value of the closing inventory and the quantity of closing inventory, you can find out using the perpetual inventory system. Obviously, this system is much more detailed compared to the periodic inventory system, and it is obviously more tedious. It is more expensive to have such system, but yes, it gives you accurate inventory information on any given date. So since we've already seen how to do inventory calculations for periodic inventory system in the previous slides. Now we will do calculations using the perpetual inventory system, where we will maintain or we will prepare detailed inventory records. We'll use this particular example to first understand the perpetual system using FIFO, and then we'll use the same example to understand perpetual system using average cost method. So perpetual system also can be maintained using FIFO or average cost or even LIFO, but since LIFO is not there in our syllabus, we are not practicing any particular example. And same way, a business can follow periodic inventory system. Under that, they can follow either FIFO, LIFO or average cost. So let's do perpetual system using FIFO. On 1st Jan, the opening inventory of 15 units of an item was held at a cost of $30. So that's the opening balance, 15 units, and cost of each unit was $30. The following information is given about purchases and sales of inventory item. So during the month of Jan, purchases were so and so, given in the column purchases, and sales were also there, given in the column sales. Prepare an inventory statement for January based on the perpetual system, assuming FIFO method. First, let's have a look at the format of the perpetual system. So if you look at the columns of this format, the first column is the date column, where we will write the date of the transaction. The second column is the purchases column. If we are talking about finished goods, we can call this column as purchases, but if this was raw materials, we can also term this column as receipts column. Under this column, under the broad purchases or receipts column, we have quantity, rate and value. So we'll write the quantities that are purchased or received, the rate at which they were received, and the value. The second column is that of sales. So this column can be termed as either sales, or if you are talking about raw materials, this column can also be called issues. And we will also term the purchases column as receipts. The alternate name could be given as receipts. So under the sales column, if you see, you again have quantity, rate and value. So what quantities were sold or issued at what rate, and the value again. And then finally we have the balance column, where we will be writing the closing balance of the inventory item after every transaction. Again, under that, the quantity left in the closing balance, the rate at which we can value that quantity, and the value of the closing balance or closing inventory. So now let's begin with this statement. If you come back to the question, and if you read the question, on top it says that the opening inventory was 15 units at a rate of $30. So coming back to our statement, we will begin our statement now. On Jan 1, we will write this opening balance under the balance column. So under quantity, we will write 15 units, rate will be 30, and value will be 15 into 30, $450. Why are we writing this in the balance column? Because this was the balance on Jan 1. This is not a purchase or a sales transaction, and hence we're not writing it in the purchase or sales column. Then on Jan 4, we purchased 30 units at $32. Going back to our statement, Jan 4, 30 units at $32. So the total is $960. And after this transaction, we need to calculate and we need to write our updated balance of inventory. So we had 15 units valued at $30, $450 from the opening. Now we have additional 30 units valued at $32, $960. What we'll do is we'll also take a total 15 plus 30, 45 units, and the total value of inventory is 1410. Then if we go back to our example, Jan 6, there was issue of 35 units at $40. In fact, this was sales. So 35 units were sold at $40. So coming to the next row, Jan 6, 35 units at $40, but that $40 is the selling price. In our inventory statement, in the sales column under the rate, we're not supposed to write the selling price. We are supposed to write the rate at which the inventory items were issued or taken out. So out of 35 units, if you see, 15 units would be issued from the first batch. See, if you see carefully, this is the batch 15 and 30. 15 is the first batch, 30 is the second batch. So 15 units would be issued from the first batch. So 15 units would be issued at a rate of 30. Why 15 from the first batch? Because we're following the FIFO. And the remaining 20, because the overall quantity is 35, 15 from the first batch, 20 from the second batch, and that will be issued at a rate of 32, because the cost of the batch received on Jan 4 is 32 per unit. So 20 units will be issued at $32 per unit. So that makes it $640. If we calculate the total, 35 units issued in total, and the overall value of issues would be $1090. Then on Jan 2, 22 units were bought at the rate of $34 per unit. So going to Jan 10, 22 units at $34 per unit, and the overall value of this batch is $748. Now coming to the balance column, see, first we had the 15 units at 30 rate. That is gone because entire 15 units from this batch were issued or sold on Jan 6. Then we had 30 units at 32. Out of these 30 units, 20 units were sold on Jan 6. So we have 10 units remaining at the rate of 32, value 320. Again, how did I get this 10? 30 from this minus 20 sold here out of these 30. So remaining 10. And now I also have 22 units from Jan 10 batch. So 22 rate 34, 748. So what is the total closing balance I have? 10 plus 22, 32 units, and the value will be 1068. So bringing forward our previous transaction on Jan 10 to the next page so that we have space below. Let's continue. After Jan 10, if we go back to our question, additional receipts or purchases were done on Jan 20, 20 units at $36. So Jan 20, 20 units at $36. Total value of purchases $720. Now again writing our balance, we had 10 units at the rate of 32, value 320. This was from Jan 4 batch, if you remember. Then 22 units at the rate of 34, 748. This is from Jan 10 batch. And now on Jan 20, a new batch is received, 20 units, rate is 36 per unit, 720. So what's the total balance that you have, or that this firm has? 52 units, and the total value of these 52 units is 1788. Then if we see our transaction on Jan 25, 40 units were issued. So let's go back to our perpetual statement. 40 units were issued at $45 per unit, but that $45 is not of relevance to us, because in our statement, the rate column, we're not going to write that 45. We are going to write the rate at which items were issued. So Jan 25, out of 40 units issued, 10 would be done from the first batch. So 10 at the rate of 32, 320 following FIFO. Then 22 would be done from the second batch. So 22 into 34, 748. And how many more units do we need to issue? Total 40. So out of 40, 32 is done. So remaining 8 units from the last batch. So 8 into 36, value 288. So taking the total of the sales column, so 40 units were issued, and if we calculate the value of these issues or sales, 1356. After this transaction, what balance is left in the inventory? The first batch is completely sold, second batch also completely sold. Then we are left with only the third batch, and out of that also 8 units are sold. Only 12 units remain from the third batch. So 12 units, value was $36 per unit, and the cost of inventory or cost of the closing inventory remaining comes out to $432. This $432 is the actual number that is important for us, because this is the end of the month. Probably if we prepare financial statements at the end of the month, $430 would be the value that we would consider even in the financial statements. So this was perpetual inventory system using the FIFO method. Now we'll do an example on perpetual inventory system using the average cost method. In fact, we'll take up the same example and do it using the average cost. So the numbers remain the same. Opening balance 15 units at $30, and then purchases and sales. Prepare an inventory statement based on perpetual system assuming average cost method. So if you see here, we have a format for the perpetual inventory system. Using the average cost method. Format is more or less the same that we saw at the time of FIFO method. One important thing that you have to remember is, in the average cost method, perpetual inventory system, every time you receive a new batch of materials or new batch of items, you have to calculate the average cost on that date. Again, I will repeat my statement. Every time a new purchase is made, whether it's of raw materials or finished goods, whatever, a new average cost has to be calculated on that date, and that average cost that you calculate will be used in future for all the issues and for all the valuation of closing inventory until a new purchase is made after that. Because when a new purchase is made after that, again you'll calculate a new average cost rate. If you've not followed what I was saying, let's do it using an example, you will understand. We have opening balance of 15 units, $30. So let's begin with that. So Jan 1, 15 units at $30, $450 value. Then on Jan 4, we received 30 units at $32. So Jan 4, 30 units, $32, and the value is $960. See, at this point, since we've received new batch of materials, we have to calculate an average rate of the overall inventory that we hold on this date, on Jan 4. So how much inventory do we hold in terms of quantity? 15 opening and 30 new, so 45 units. And what is the total value of these materials? 450 is the value of opening and 960 is the value of the new materials or new products that are received. So the total comes to 450 plus 960, 1410. We will have to arrive at the average rate by saying 1410 divided by 45 units. And when we do that, we get $31.33. Basically, again, I will just repeat my statement. Whenever a new batch is received, you have to calculate the average rate of all the materials as on that date. So how do you calculate the average rate? You take up the total of the value and divide it by the total of the quantity. So that's what we've done here. 1410 is the total of the value of opening and new batch, and we divided it with the total of the quantity, which is 15 plus 30. We get an average rate of $31.33. This value is now very important for all future issues and future closing balances until we receive a new batch. So after Jan 4, we then sold items on Jan 6, 35 units. So Jan 6, in sales column, quantity 35. And what is the rate that we're going to use? The average rate that we've calculated, 31.33. So 35 into 31.33, 1096.55. And after 35 units are issued or sold, what is the quantity remaining in balance in closing inventory? 10 units, and the rate of this is 31.33. So the value of the closing inventory on Jan 6 is 313.30. Then on Jan 10, we received 22 units at $34. So Jan 10, 22 units at $34 per unit, $748. We'll have to arrive at the new balance in terms of rate, in terms of quantity and value. So first let's see the quantity column. 10 plus 22, total quantity available is 32 units, and in terms of value 313.3 plus 748, that's the opening value plus the value of new purchases. If we sum it up, we will get 1061.3. Using this, now we will have to arrive at the average rate. So 1061.3 divided by 32 units. So the average rate that we get is 33.17. This rate will be important in future until we receive a new batch. And I think we receive a new batch after this again. Yes, Jan 20 units at $36. So again, Jan 20 units at $36, 720. So this time, how much do we have in balance? In terms of quantity, 32 plus 20, 52. And in terms of value, 1061.3 plus 720. So 1781.3. Just try calculating the average rate on your own, and then you can continue with this and look at the number so that at least you know that you are following and you know how to calculate it. So 1781.3 divided by 52, $34.26 per unit. Then on Jan 25, 40 units were issued. So Jan 25, 40. What rate will you use? The previous average rate, 34.26. So the value of the sales is 1370.4. Not value of sales, but the value at which the sold items were issued from inventory. And balance left is 12 units at the rate of 34.26, 411.12. So that completes our perpetual system using the average cost method. And again, in this case, this 411.12 is very important for us because this will be used in the financial statements also if we prepare one at the end of Jan. And finally, we come to the last part of this video where we're going to compare the perpetual versus the periodic system in terms of the value of inventory. What I mean to say is the value that we calculate for any given set of transactions under the perpetual system and the periodic system, is it same, or do we get different values when we follow the periodic system and when we follow the perpetual system? That we will see now in a bit. So the same example that we followed for perpetual system, I'm going to write the value for perpetual system under FIFO and AVCO, whatever we got in our previous slides. So let's go back and just see once. So if we see the perpetual system FIFO, we got 432. And if we see the perpetual system average cost method, we got 411.12. So I'm just going to write it down here, $432 and $411.12. Now what you are supposed to do is calculate the value of the inventory under FIFO and average cost method using the periodic system, using the concepts that we studied just before the perpetual system. Just try to do it on your own, and then you can continue with this video to at least ensure that yes, you've learned how to calculate the value of inventory, at least using the periodic system, because that's still the easy part. So for perpetual system, you may have to practice 1 or 2 more questions and then you will get it. So just pause the video, calculate the value as per the periodic system under both FIFO and average cost method, and then continue with this video. So I'm going to calculate the value here. So if I first start with the FIFO method, first let me see how much is the quantity left at the end. We've already done this question, so I know that at the end we have 12 units, But let's say if you don't know 12 units, how can you calculate? You see the opening balance 15 units, you sum up the purchases 15 plus all the purchases, and then you subtract the sales. Whatever value you get, that will be the quantity remaining in stock. And for FIFO, what rate are we going to use? We know that in FIFO, the materials that were received first or that were available first will be sold first. So the closing inventory will always remain from the latest batch, and the cost of the latest batch is $36 per unit, which is Jan 20 batch. So 12 into 36, 12 into $36, if I calculate the value of closing inventory, I get $432. So let me put it here down, $432. Now I'm going to use the average cost method. So under average cost method, our first step is to calculate the average cost of materials received during the entire month. So quantity still remains 12 units here. But for rate, I will have to do the calculations. So I'm going to take up the opening cost, opening items, and the purchases and see what is the average cost. So opening, there were 15 units into $30 plus, then received 30 units at $32 on Jan 4, then received 22 units into $34, and then finally received 20 units at $36. The total, I will be dividing it with 15 plus 30 plus 22 plus 20. That's the total of quantity actually. And when we do this, we get an average rate of $33.08. So based on this, what will be the value of closing stock? 12 units into $33.08 per unit, which works out to $396.96. So let me put it down here in this table, $396.96. So if you compare the FIFO under perpetual system and periodic system, it is giving you the same value of inventory. So when it comes to FIFO, it really doesn't matter what inventory system you're following, you will always get the same closing inventory value at the end. But when it comes to average cost method, if you see, the values are different. They're not the same. So for average cost method, it really matters what type of inventory system you're following, and accordingly the value will change. So this is one thing that I would really want to tell you, that for FIFO the value would be same under perpetual and periodic, but for average cost method the values will be different. So I hope you've understood a lot about inventory valuation and the concepts related to FIFO, average cost, perpetual and periodic systems, and I hope it'll help you. If you think that the video was useful, please like the video, please share the video with your friends. You can subscribe to the channel so that in future whenever I post videos on accounting or costing, you will get notified and you will be able to watch the videos. Thank you for being there. I'll see you in the next one.